When the crowd is staring at smoke, I start looking for steel. That is one of the oldest habits I have, and it has saved me more times than intelligence ever did. Most people think money is made by reacting quickly to the loudest headline. It is not. Money is usually made by identifying which quiet structure is still being built while everyone else is running toward the fire. The fire gets the cameras. The structure gets the returns. That is where we are right now. Everyone has been glued to the Iran conflict. They have been watching oil, listening to threats, waiting for the next presidential outburst, and treating their portfolio as though its future depends entirely on whether one more missile flies or one more ceasefire holds. I understand the impulse. Human beings are wired to stare at danger, but staring is not the same as thinking, and markets pay for thinking, not staring. The market right now is teaching a brutal lesson. In the short run, prices can swing on geopolitics, on rhetoric, on one-night fear, but underneath that noise, capital is already choosing the next layer of winners. It is moving toward compute, toward memory, toward custom silicon, toward enterprise AI security, toward orbital infrastructure, toward the companies that are not merely beneficiaries of attention, but owners of the bottlenecks that attention eventually must pay. That is the line I want you to follow. Not the explosions, the bottlenecks, because bottlenecks are where real wealth accumulates. I have seen this many times in other costumes: railroads, insurance, float, consumer distribution, payment rails, cloud infrastructure. The details change, the rule does not. When a new industrial cycle begins, the crowd usually buys the most visible symbol first, then slowly realizes the symbols are not where the deepest economics live. The deepest economics live in the toll booths, the pipes, the chips, the memory, the switches, the rails, the data centers, the recurring software hooks, the things the glamorous layer cannot operate without. That is what I believe the market is quietly repricing right now. It starts with fear. Fear is one of the only truly useful emotions in markets, but only if you are capable of standing outside it. Most investors drown inside fear. A smaller number learn to read it as a thermometer. When the crowd becomes irrationally fearful, the environment begins to change. The exact timing is never clean. The exact bottom is never polite. But valuation and opportunity start moving back into the same room. That is why I respect extreme fear indicators, not because they are magic, but because they reveal when emotion has become measurable. If everybody is panicking at once, somebody somewhere is selling for reasons that have more to do with discomfort than with value. When that happens, good assets get marked down beside mediocre ones. That is the beginning of possibility. I have never needed perfect certainty. I have needed favorable imbalance. That is the first mechanism. I call it the panic discount mechanism. The panic discount mechanism is what happens when a broad external shock drives people to lower their standards for selling, but not their standards for storytelling. They still tell themselves they are being rational. They still decorate the sale with logic. But what is really happening is simpler. They want relief. Relief is expensive. The person selling for relief is paying you in future upside. That does not mean every fearful market is automatically a shopping spree. Some things deserve to go lower, some businesses are weak, some narratives are empty, but fear changes the baseline. It changes how much work you need to do to find a mispriced quality asset in calm markets. Quality tends to be expensive in fearful markets. Quality can begin slipping closer to reason. That is when I become useful to myself. And that brings me to Microsoft. If a great business falls to a place where long-term buyers historically begin stepping in, you should pay attention. Not because lines on charts are holy, they are not, but because long-term moving averages on exceptional businesses can reveal when the market has gone from admiration to temporary contempt. That transition is often profitable. Microsoft interests me here because the stock has been treated as if it were guilty by association with every other overowned mega-cap technology story. Yet the business underneath has not behaved like a failing giant. Revenue is still expanding. Gross profit is still expanding. Earnings power is still expanding. The core commercial franchises are still embedded. Cloud remains strategic. Productivity remains sticky. Enterprise relationships remain vast. And on top of all that, the company sits in one of the strongest seat positions in artificial intelligence distribution on Earth that matters. A great many investors look at AI as if it is a race to invent the smartest model and nothing else. That is, childish models matter. Distribution matters more. Enterprise trust matters more than that. Installed workflow matters more than both. In many cases, Microsoft is not just chasing intelligence. It is wiring intelligence into environments where companies are already locked in, already paying, already training employees, already building process around the platform. That is why I think the market can become too dramatic about a 20% decline in a name like this. The business did not fall 20%. The enthusiasm did. There's a big difference. That is the second mechanism. I call it the compression gift. The compression gift appears when a stock multiple contracts faster than the company has strategic role. This is one of my favorite setups because the market tends to understand it late. Everybody notices a collapse. Fewer people notice a compression. In a collapse, the business breaks. In a compression, the price adjusts downward while the business keeps quietly widening its roots. That is a much more interesting event. Microsoft feels to me like a compression gift. The market is saying, you were too expensive. The business is saying, fine. I will keep growing while you calm down. That combination can be wonderful for a patient buyer. Now let us move deeper into the part of the market where the excitement feels more industrial and less polished. Nebius is not the sort of name ordinary investors comfortably hold at dinner, table size. It is smaller, wilder, and more dependent on the forward build-out of AI infrastructure. That scares people. Good, it should. Fear is healthy when a company lives closer to the metal than to the brand, but fear is not analysis. And analysis demands you distinguish a fragile story from a scaling platform. The reason Nebius matters is not because it has become a famous ticker. It matters because it is being treated by much larger players as though it occupies real territory in the sovereign and regulated AI infrastructure stack. That is a different kind of endorsement. When the companies building the deepest compute ecosystems start placing serious capital and serious demand beside a smaller infrastructure name, you are no longer just looking at a speculative cloud story. You are looking at a name that may be moving from optional capacity into required capacity. That shift is where the asymmetry lives. It is one thing to have a good presentation about the future of AI. Half the market has that. It is another thing to have actual counterparties with actual needs effectively saying, we will put our workloads, our timelines, and our capital in the direction of your infrastructure. That is harder to fake. The numbers involved are also large enough that they change the mental category. Once a small infrastructure company begins talking not in millions but in many billions of committed or potential annualized demand, the market can no longer assess it like a neat little side story. It has to begin wrestling with what scale would look like if execution actually follows. This is where most investors become clumsy. They hear a large forward number and leap directly into fantasy. I do not do that. I do not skip the ugly middle. The ugly middle is where build-out, timeline, power, delivery, counterparties, and actual execution decide whether the dream survives contact with Earth. But the ugly middle is also where the market misprices the future most often. That is the third mechanism. I call it the capacity recognition gap. The capacity recognition gap exists whenever the demand case is becoming legible faster than the market can emotionally process the amount of capital, infrastructure, and execution required to satisfy it. In that gap, the stock can look too risky to the timid and too obvious to the reckless. Both groups get it wrong. The first ignores the scale of the opportunity. The second ignores the difficulty of earning it. The intelligent investor lives in between. Nebius is one of those in between stories. It is not safe, it is not settled, but it is not trivial either. If the infrastructure gets built, if the counterparties stay real, if the compute comes online, if the annualized revenue path begins hardening, then the stock will not be repriced in neat little increments. It will be repriced violently because the market currently does not know whether to treat it as a possible curiosity or a future platform. I like situations where that classification is still unsettled. They are dangerous. They are also how fortunes get made. Now, let us move to Marvell because Marvell is a different creature altogether. The average investor thinks about chips too loosely. They think in brand names and GPU heroes in whichever stock had the most dramatic chart last year. That is surface thinking. The AI stack is not one chip, it is a system. CPUs, networking, interconnects, optical pathways, custom silicon, memory, power management, all of it has to function together or the expensive glamour at the top becomes useless. That is why Marvell matters. Marvell lives inside the connective tissue of the build-out custom chips, networking, silicon photonics. Infrastructure pathways that make the rack itself more capable and more scalable. If NVIDIA remains the most visible gravitational center in AI infrastructure, then there will be extraordinary value in the companies it chooses to pull closer into its own operating universe. That is not because proximity alone is enough. Plenty of adjacent companies remain mediocre. It matters because ecosystem inclusion changes demand visibility. It changes customer perception. It changes what large buyers assume is compatible, scalable, and future. Proof enough to design around. That is the fourth mechanism. I call it the inner circle repricing. A stock does not need to become the emperor when it gets invited into the emperor's war room. It only needs the market to understand that its role inside the empire is bigger than previously assumed. Inner circle businesses often re-rate not because their current quarter changes dramatically, but because their long-term strategic relevance suddenly becomes easier to imagine. That imagination can be worth billions. Marvel's position here is important because it sits at exactly the place where AI infrastructure gets expensive enough that optimization becomes mandatory. When data centers are becoming denser, hungrier, faster, and more power-constrained. The old assumption that only the obvious chip winners matter becomes lazy. The less glamorous components become more valuable. Not less, because inefficiency becomes intolerable at scale. That is what serious investors understand. As systems get larger, the friction points become more profitable than the headlines. This same logic leads naturally to Broadcom. Broadcom does not need a romantic story. It never did. I admire that romantic stories often attract weak capital. Broadcom is a hard edges business. It lives where enterprises and hyperscalers pay real money to solve physical and digital throughput problems. It is not trying to impress you, it is trying to be indispensable. And right now it sits in an unusually good place. Custom AI silicon, networking infrastructure, long-term supply entanglements with hyperscalers, exposure to the layer beneath the model war, exposure to the place where AI stops being an abstract wonder and becomes a logistics problem. That is where big money eventually has to spend. One of the reasons I respect Broadcom here is that it is not built on a single heroic assumption. Too many investors still think in one company stories. They need one winner, one chart, one symbol, one identity to attach themselves to. Broadcom is more intelligent than that. It is a picks and shovels business inside a market that keeps rediscovering that picks and shovels are sometimes more stable than the prospectors. If Anthropic, Google, and other major AI players are going to keep driving compute demand higher, then the firms that design and supply the less glamorous but essential layers of that build-out can become much more valuable than their relative lack of public drama suggests. That is why I like Broadcom. Not because it feels exciting, because the economics feel necessary. Necessary is better than exciting. Exciting gets sold, necessary gets repriced upward for years. Now I want to talk about a development that frightened the wrong people and may enrich the right ones. Whenever efficiency breakthroughs appear, lazy investors leap to the conclusion that demand for the underlying inputs must fall. They see a 6-fold reduction in memory footprint or an 8-fold acceleration in a particular inference operation and immediately imagine a future where fewer chips are needed, fewer memory modules are needed, fewer dollars must be spent. They have forgotten one of the oldest economic truths in industrial history. When the cost of a useful thing falls, demand for the useful thing often explodes. The market keeps relearning this lesson because it keeps wanting the world to be simpler than it is. That is why I think the memory trade may still be badly misunderstood. If new techniques make large model serving cheaper, leaner, and faster, that does not automatically shrink the total opportunity for memory. It can expand it. Cheaper inference means more use cases become economical. More deployment means more models in production. More models in production means more data movement, more context, more concurrency, more real-world load. The pie gets larger. Efficiency can make the pie much larger. This is the fifth mechanism. I call it the efficiency explosion. The efficiency explosion is what happens when a bottleneck appears to loosen and the market forgets that lower friction can unlock much higher total system usage. The market says, less memory needed per task. The more thoughtful observer says, perhaps far more tasks now become profitable. Those are not the same conclusion. That is why Micron interests me. Memory is no longer a disposable commodity hiding in the basement of the story. In AI systems, memory affects throughput, latency, cost, and practical capability. If the workload world keeps expanding, memory remains a choke point. And choke points in scaling systems become valuable in ways the market often only understands after margins start proving it. Micron's recent operating numbers matter because they are not just decent, they are explosive. When a business tied to a supposedly commoditized layer starts posting that kind of revenue and earnings acceleration, you should stop calling it a commodity business and start asking whether the category itself is being repriced. Category repricing can last much longer than people expect because it is not merely about one company. As good quarter. It is about the market realizing a whole layer of the stack deserves a different multiple, a different respect level, a different future. That realization can take time. I do not mind time when the direction is right. And if someone wants a basket rather than one name, I understand the appeal of a memory-focused ETF in a world where memory may be the most constrained and least emotionally appreciated layer of the AI stack. Constraint, when real, is where the money likes to gather. Now let us step out of the data center and into security, because this is where the AI story gets darker and more profitable. At the same time, the crowd likes to talk about AI as if it were a race to make machines more useful. That is only half the story. Every leap in offensive capability creates a need for defensive capability. If more powerful models can discover vulnerabilities, navigate infrastructure, and reason their way into ever more dangerous territory, then the companies protecting enterprise and critical systems do not become optional. They become first responders. This is why I pay close attention when frontier model builders start restricting a Model S deployment to a hand-picked security coalition. That tells me something important. It tells me the tool is not just commercially interesting, it is systemically dangerous and therefore commercially central to defense. If companies like CrowdStrike and Palo Alto are getting access to more powerful tooling earlier than much of the competitive field, then the AI wave is not only about productivity, it is about advantage in cybersecurity. And cybersecurity is a category the market will always underestimate until a few spectacular disasters teach it manners again. That is the sixth mechanism. I call it the defensive acceleration loop. As tools become more capable, the cost of being undefended rises. As the cost of being undefended rises, the market for high-quality defense platforms widens. As that market widens, the companies best positioned to absorb frontier AI into protective workflows can become more central, more sticky, and more indispensable to the enterprise. The loop feeds itself. That is why I do not think of CrowdStrike and Palo Alto as merely security companies anymore. I think of them as intelligence filters in a world getting too dangerous to navigate without better machine assistance. That can be a very profitable place to stand. Now, I want to address ARM because it is tempting to see a company entering a hot race and assume the stock must be the move. I am more cautious. When a licensor begins competing directly with some of the very ecosystem participants that used to treat it as neutral architecture, the economics become trickier than the surface story suggests. Yes, the opportunity could be huge. Yes, the long-term shift in data center CPU dynamics matters. Yes, major names lining up to use the new chip is serious. But serious is not the same as simple. This is one of those moments where the market can get seduced by technological importance without fully pricing ecosystem tension. I do not hate ARM here. I simply think the cleaner picks are elsewhere for now. You do not need to buy every intelligence story. You only need to buy the ones where the reward to confusion ratio works for you. That is an underappreciated discipline. Restraint is part of investing. Now, we cannot finish this without talking about SpaceX. But I do not want to talk about it the way the crowd does. The crowd wants to know the ticker, the valuation. The first day pop, the roadshow, the precise month, the headlines, the bragging rights. That is not how I think about it. I want to know something else. What does this IPO validate? Because that is the real question. If SpaceX comes public at an extraordinary valuation with rockets, satellite, internet, AI infrastructure ambitions, and perhaps a much broader technological wrapper than a simple launch company, then the listing is not just a financing event, it is a capital signal. It tells institutions, sovereign funds, large allocators, and retail speculators that space is no longer a science project hiding on the edge of the market. It is a destination. When a destination becomes legitimate, money floods not only into the star but into the roads leading to the star. That is why I find the whole orbital data center vision so interesting, even if pieces of it still sound audacious. Whether or not the full dream arrives on the current timeline, the strategic intent itself matters. It tells you how the largest players are beginning to think. They are thinking beyond Earth-bound energy constraints, beyond traditional real estate limits, beyond standard compute geography. Once people with scale begin thinking that way, the industrial consequences are rarely confined to one company. That is the seventh mechanism. I call it the validation shockwave. The validation shockwave occurs when one company's size and audacity pull an entire adjacent ecosystem into institutional legibility. A field that once sounded fringe becomes investable. A pile of strange, smaller names suddenly looks like exposure. A whole category moves from optional curiosity to capital destination. That is why I keep saying the crowd is staring in the wrong place. It is staring at the war. It should be staring at the bottlenecks and the validation shockwaves the war is distracting it from. Because while one part of the market is pacing around the television, another part is underwriting the next decade. This is what I want you to understand at the deepest level. Wealth in public markets is not built by being omniscient. It is built by being one layer deeper than the average participant. The average participant sees a RAN and sells. The average participant sees a memory efficiency breakthrough and assumes memory demand dies. The average participant sees a giant future IPO and decides to wait for the giant. The average participant sees software fear and sells all software together. The average participant sees security as old news until the next breach. Do not be average. Average is expensive. Instead, ask the adult questions. Where is demand becoming more real than the market? Emotions. Which inputs are becoming more scarce than the headlines admit? Which companies are being pulled closer to the center of a growing ecosystem? Which categories are shifting from story to necessity? Which shockwaves are about to make a whole group of businesses newly legible to capital? Those are the questions that get you paid, not immediately, not neatly, but repeatedly. Now let me bring this into a protocol, because insight without protocol is entertainment. First, when fear is high, stop asking whether the market feels safe and start asking whether quality is being marked down beside noise. Second, inside AI, think in layers, not heroes, models. Yes, but also memory, networking, custom silicon, enterprise distribution, and defense. Third, respect category shifts. Memory is not just memory anymore. Security is not just security anymore. Space is not just rockets anymore. Once a category changes function, it deserves to change valuation. Fourth, separate maturity from attractiveness. Microsoft can be attractive because it compressed. Nebius can be attractive because the market still does not know what category to place it in. Both can work for different reasons. Do not demand one template for every winner. Fifth, never let a great story blind you to a better bottleneck. Bottlenecks collect tolls. Heroes collect headlines. Tolls usually compound better. That is how I would think about April 2026. Not as a month to panic about the loudest thing on television, as a month to buy into the quieter structures the market is underpricing because it is emotionally overcommitted elsewhere. If I were beginning from scratch, I would want positions in the names that sit where demand is hardening and misunderstanding still exists. Microsoft, because compression created an opening in a giant whose relevance is still widening. Broadcom, because it occupies the necessary middle of the stack. Micron and memory exposure, because efficiency can increase total system demand, not reduce it. CrowdStrike and Palo Alto, because the defensive loop is only becoming more essential. Nebius and Marvell, because the ecosystem is pulling them inward before the crowd fully appreciates what that means. And I would keep watching SpaceX not as a celebrity event, but as a field-wide validator. That is the frame. That is the edge, not the brightest object. The steel beneath the smoke. The market is always throwing distractions at you. War, tariffs, personalities, threats, false bottoms, sudden rallies. It wants to know whether you are a spectator or an allocator. Spectators react to noise. Allocators look for structure. I have spent my life choosing structure. You should too. Because years from now, when people look back at moments like this, they will tell the story through the loudest headline. That is what history books and YouTube thumbnails do. But the money will not have been made in the headline. The money will have been made in the names quietly gaining leverage over the future, while everyone else was busy guessing how the next night's news would sound. That is how this game really works. And once you see it, you stop waiting for the market to calm down before acting intelligently. You act intelligently precisely because the market is not calm. That is what gives you the price. That is what gives you the edge. And that is what, over a lifetime, gives you the difference between merely watching history and owning a piece of the machinery that built it.